Hi everyone, welcome again to RHB Assets Management Podcast Series. I'm Fauzi, Chief Investment Officer, Equity Malaysia. We have seen global equities rallied from their March low. The equity market performed much better than the real economy. Among few reasons why the equity market performed strongly includes massive liquidity injection by central banks, decreasing number of new positive COVID-19 cases, reopening of economies as number of new COVID-19 subside, and positive development on vaccine trials. FBM KLCI index has also been performing strongly with other regional indices after falling sharply by almost 22% from early February to 19 March. As of 29 May, the index has rebounded by 20.8% from the March low level and only 7.3% down year to date. The rebound has been very swift and took around only 2.5 months. However, the economic fundamentals do not justify such a significant and swift jump in the index. As we know, the crude oil price and crude palm oil price have come down significantly as demand collapsed due to COVID-19 pandemic. Hence, this will reduce government's revenue this year. In addition, we are also seeing the negative impact of COVID-19 pandemic on the local manufacturing activities and Malaysia export as a result of lower demand and lockdown globally. The weak economic data and lower government's revenue will have a negative impact on Malaysian economy in 2020. Hence, could the rally in the equity market sustain, or is it just a bear market rally? Manufacturing activities dropped sharply in April after 1.5 months of movement control order implementation. Although Malaysia economic growth of 0.7% in the first quarter 2020 came in above consensus, it was due mainly to the strong economic performance in February and early March, which was ahead of the movement control order. Besides slower manufacturing activities, Malaysia export will suffer as well. March export fell 4.7%. Exports were hit by both softer end demand and movement control order implementation from 18 March. Exports drag are likely to intensify going forward, with businesses either shutting down or operating below full capacity. On the other hand, as mentioned earlier, the equity market has been going upwards and has been ignoring the weak macro data, although the impact of COVID-19 on the economy is much worse than global financial crisis. During global financial crisis, the FBM KLCI fell significantly over 5 months from mid-May 2008. The index fell by 36% and touched the low of 832. The index rebounded by almost 11% over 3 months period and started to fall again by 8% for another 2 months. The index then consolidated for 6 months before the index moved up on sustainable basis from April 2009. It took 16 months to complete the whole cycle. However, it is different this time round. As of now, share prices have not formed such a base. Typically, for a new durable bull market to emerge after a vicious bear market, a consolidation period or a base building phase is needed. If history is any guide, the speed of the rebound in global and local equities is more consistent with a bear market rally than the beginning of a new bull market. Another point worth looking at is the prerequisite for an ultimate bottom of the market is the end of the corporate earnings downward revision. However, corporate earnings are still being revised down and valuations have not priced in an earnings recession. We expect more downside risk to consensus earnings. The ongoing quarterly corporate results that are under our coverage saw more corporates reported earnings which were below market expectation. The result only take into consideration of 2 weeks movement control order which was implemented from 18 March 2020. So far, the cuts in consensus earning estimate for 2020 is only 12.6%. Hence, we still see room for more downward revisions. Typically, during recession, corporate earnings are likely to contract between 20% to 30%. Year to date, foreign investors have sold 12.3 billion ringgit of shares in the local market. The local market has been supported by local institutional buying for the past 10 years. The index will perform better should we see more foreign portfolios flows into the market. It is unlikely that a definite equity market bottom has been established so quickly. In the short term, we expect equity market to be volatile and range-bound as the market is adjusting for the new norm in the economy. Thank you.